Hey everyone, and welcome to today's Explainer. We're jumping right into a daily financial news style breakdown of the current market crosscurrents. Today, we're going to systematically unpack the really complex dynamics driving the market right now. We'll be heavily focusing on the AI supply chain, the shifting macroeconomic reality under the Federal Reserve's rate path, and some highly specific tactical trading strategies for July. Let's dive right in. Here is our roadmap for today. We're looking at the macro view for July and earnings, then the AI supply chain bottleneck, the big clash between tech giants and memory makers, and finally, the semi-equipment defensive shield.
All right, Section 1, the macro view and July earnings.
So historically speaking, the first half of July is known for having incredibly strong market seasonality. But you might be wondering, does the internal data actually support that optimism right now? Well, take a look at this. Despite a recent massive $30 billion pension fund sell-off as institutions rebalance into bonds, market breadth is actually getting better. Right now, 64.5% of S&P 500 stocks are trading above their 200-day moving average. This tells us the recent volatility, it wasn't a market top at all. It was just a healthy internal rotation. While the major indices dipped, the broader market actually gained a lot of strength. But to really ground our strategy, we have to look at the actual price tag. The S&P 500 forward price-to-earnings ratio currently sits right at 20.1 times. That's slightly above the 5- and 10-year historical averages. Now, to see if paying this kind of premium is justified for your portfolio, we have to weigh the two great anchors of valuation: the Fed's interest rate path and expected corporate earnings growth. And honestly, this is exactly where the premium starts to make sense. Institutions like Goldman Sachs and Bloomberg are projecting a massive 22 to 23% jump in Q2 corporate earnings. The much-anticipated AI dividend is finally spreading out. It's moving away from just the pure hardware monopolies and trickling all the way down to the broader supply chain, stuff like power, infrastructure, and traditional servers. If this surge materializes under current rate expectations, well, that 20.1 times valuation isn't just justified, it's potentially cheap. Moving along, Section 2, the AI supply chain bottleneck. Okay, so realizing those expected earnings requires actual physical infrastructure, but unprecedented capital expenditures are creating some really severe bottlenecks. And it's not just a single shortage, it's like a cascading failure of capacity. It all starts with this totally insatiable demand for GPUs, but GPUs need high bandwidth memory, which is now incredibly scarce. Then you hit hard limits in advanced packaging, and finally, literal physical constraints with server racks, cooling, and the power grid itself. This sequential spillover is creating an intense inventory squeeze, and it's driving up semiconductor prices way faster than traditional commodities. The scale of this bottleneck is just staggering. It's so massive that corporations literally can no longer solve it alone. State-backed capital is actively entering the fray now. South Korea is pushing an astonishing 800 trillion won mega investment. That translates to roughly $500 billion over the next 5 years. They are aiming to completely double their memory manufacturing capacity and construct this massive 260,000 GPU computing network. When sovereign nations start treating compute power like national defense, it signals to us that demand here is practically guaranteed for years to come. Which brings us to Section 3, tech giants versus memory makers. Deep within the supply chain, there's basically a high-stakes corporate Cold War breaking out. You've got massive buyers like Apple and Meta fiercely pushing back against the absolute pricing power held by the big three memory makers, Micron, Samsung, and SK Hynix. The memory oligopoly is purposely shifting resources over to highly profitable AI memory. This restricts the traditional DRAM supply and sends those prices skyrocketing. So the tech giants, totally tired of having their margins squeezed, are threatening to take their business elsewhere, which is fundamentally shifting the industry dynamics. And you know what's serious when this pressure spills out of the boardroom and straight into the legal realm? Just recently, those big three memory makers found themselves facing a class action antitrust lawsuit over in a California federal court. A group of consumers and retailers are straight up alleging that these memory giants colluded to restrict traditional DRAM supply and artificially manipulate prices. But if you read between the lines here, a lot of industry insiders suspect this is actually a highly calculated move by downstream giants to just break the memory makers' leverage. For example, Apple is reportedly lobbying the US government to exempt Chinese memory maker CXMT from restrictions. Why? Because threatening to use a cheaper alternative is the ultimate way to force the current memory oligopoly back to the negotiating table to lower their prices. It is a brutal game of corporate chicken. Finally, Section 4. The semi-equipment defensive shield. So, with the middle of the supply chain turning into this chaotic battlefield over profit margins, smart money is looking for places to hide. Institutional capital absolutely hates uncertainty. So, the crucial question for us is, how do retail investors and funds actually navigate this conflict without getting caught in the crossfire? If Apple wins, the memory makers suffer. If the memory makers win, the tech giants' margins shrink. So, how on earth do you play a game where the winner is totally unclear? It's simple. You sell the shovels. Smart money is rotating strictly into upstream semiconductor equipment manufacturers. We're talking Applied Materials, Lam Research, and KLA Corporation. The rationale here is brilliant. Whoever wins the pricing war between, say, Apple and Samsung, it doesn't actually matter. The foundries and memory makers absolutely must buy the manufacturing tools and metrology equipment from these three companies just to build the data centers and expand their capacity. That upstream certainty acts as a perfect defensive shield. And just to underscore this need for precise, really surgical positioning, look at this critical data point. The correlation between the equal weight index and the S&P 500 has plummeted down to a historic low of 79%. That is far below the usual 96%. What you should take away from this is that the market right now is entirely fragmented. You cannot just blindly buy the index anymore and expect a rising tide to lift all boats. The market is trading based on incredibly specific micro-narratives and totally isolated sectors. Because of this, our July tactical playbook dictates a highly disciplined approach. First off, prioritize holding about 12 to 15% in cash, just so you have dry powder for these volatile swings. Second, maintain core memory positions like Micron despite all the noise, and just wait for clear earnings confirmation. You can use peripheral DRAM stocks purely as a risk valve, trading them lightly. And most importantly, literally, do not aggressively chase weak tech stocks hoping for a rebound. Stick strictly to companies showing confirmed strength. We're going to leave you with this final, somewhat provocative thought. As Q2 earnings rapidly approach, the valuation of the entire market basically hinges on one critical question. Will these billions of dollars in AI hardware investments finally prove their worth in actual software and consumer profits? The grace period for just building the infrastructure is ending, and Wall Street now wants to see the real return on investment. If they don't see it, the market's tone could shift dramatically. Keep your eyes on those earnings, stay disciplined, and we'll be right here to explain it all as it unfolds.